What's more important, earnings or interest rates? We're going to go deep on the stock market here and take a look at how direct the effect is of a single stock's earnings on the stock market at large, how direct an effect is of the Fed or any central bank changing interest rates higher or lower on the stock market at large in advance of a huge economic calendar, a couple of weeks we have ahead, and some of the most important central bank meetings out of the U.S. Federal Reserve in years, as now the U.S. is above 5%, and everyone's wondering, are we going to go higher than 5%, or is this where we're going to top out and move lower? So very relevant time to talk about the effect of earnings or interest rates on the stock market. Let's start off with earnings and give a little bit of backdrop for why a single stock's earnings might be so relevant. Because you might say, hey, man, I got investments in the S&P 500. That's 500 stocks, Frank. One earnings report out of Apple or Google is not going to take me down necessarily. Well, we're seeing a very highly concentrated stock market. And one, it's very highly concentrated in tech. You can see the top 7 names here from the S&P 500 currently are technology sector stocks. So one, you're highly focused in tech. Two, look at some of those big names. I mean, Apple has been climbing to new all-time high after new all-time high over the course of the last several years, and now garnering almost 8% of the stock market. One of 500 stocks in the S&P 500 garnering 7.7% weighting, and Microsoft's not far behind. It's not just, Apple and then the next highest weighting is, 1% or lower, which you would imagine with a 500 stock index, a very high concentration, 25% of the S&P 500 in these 7 stocks. And then you go on to the NASDAQ, which is obviously even more concentrated in technology and more concentrated in these top 7 names. 50% of the NASDAQ, more than 50% in Apple, Microsoft, Google, Amazon, NVIDIA, Tesla, and Meta. And so when you have such high concentrations and you have a real deep schedule of earnings coming out in not only the tech sector, but some of these big names. We've got Microsoft coming out this week. We've got Google coming out this week. We've got Meta coming out this week. It can make that market very vulnerable to these earnings. If the earnings are good, that's going to be good for the stock market. If the earnings are bad, they're going to be bad. That's going to be bad for the stock market, because let's say that given those weightings we just looked at, Microsoft around 7%, and if Microsoft has a more than 10% move, which isn't that abnormal for an earnings, more than 10% move one way or the other could swing the entire S&P 500 by almost a percentage point or more if we get to 15-20% move out of Microsoft. So one stock, that might not seem like a lot, but one stock swinging the stock market by a percentage point or more, keeping in mind that we're trying to if we're invested in the stock market, look for those historical returns that average to around 6 or 7%. 1% from one earnings cycle from one stock can really move around those investments if you do invest in the S&P 500 or the NASDAQ 100, even more so. And so very, very relevant, and obviously a pretty direct effect. And then also you have the FOMC meeting that's midday on Wednesday, the 26th. We'll get to that in a second. But Tuesday and Wednesday, very full schedule between Microsoft, Google, and Meta, just to do the quick ballpark math here. That is, more than 10% of the S&P 500 will report earnings by weighting here this week. And you can see the direct effect. Just look at last week. Netflix and Tesla reported worse than expected earnings. And here I've got in the backdrop the Netflix earnings announcement, and you can see worse than expected revenue. They took a dip in terms of year over year percentage growth. It looked like from the fourth quarter of 2022, which was, you'll remember, the stock market was not doing so hot. If you look at the black line, there is the NASDAQ. And you look at the latter part of 2022, the stock market's mining the lows that we saw for the last couple of years there. And you can see the year-over-year growth in Netflix earnings at 1.9%, off considerably from where it was in the early part of 2022 and 2021, coming out of the pandemic. A lot of stocks doing well, 1.9%, less than half of what they were doing in prior quarters. And then the bounce back in the first quarter of this year, feeling like, oh, we're going to, continue higher, continue this pace back to, 5, 6, 7, 8% revenue growth here, a drop off in the last quarter. And you can see they're coinciding with the NASDAQ getting up to 16,000 and then falling several hundreds of dollars lower, and Tesla also taking a big chunk out of that here with these high weighting stocks in the NASDAQ. So you can see the direct effect here, whereas the interest rate environment is going to be a little bit more nuanced because we've now seen the Fed hiking interest rate for the last year and a half. And in 2022, as they went from 0% interest rates to 1%, 2%, 3%, the stock market moved lower in 2022. Now in 2023, the stock market's bounced back, but it's not like the Fed has been cutting interest rates. The Fed actually went to 4%, and we're now above 5%. And the market is pricing in another 25 basis point hike in July's meeting here, more than a 99% chance as of today at July's FOMC meeting. It's been historically a relationship of higher interest rates, more expensive money. If technology stocks that are high growth, depending on more money fueling that growth, and if interest rates are going from 0% to 5% and potentially even higher here, that is going to cut into some of that growth. It's been a relationship of bearishness in stocks in 2022. In 2023, the stock market's been able to see a bounce back. We just saw in the first quarter, Netflix reported higher earnings than the last quarter of 2022. So the stock market's been able to shrug off these higher interest rates. But what could really shake this market is not the fact that we got a 99% chance of the rate hike here in July. That's already been priced in by this Fed funds futures market from the CME group. And just as we're looking at it here, the stock market and everybody who is buying and selling the individual stocks or the index futures and options and ETFs and everything else knows this information. Now, what could potentially shake this stock market with interest rates is if the Fed chair, Jerome Powell, comes out and says, we're really worried about inflation still. We think we might get to 6%, 7%. The market hasn't priced that in. They would be, that type of fear could shake the stock market. Now, on the flip side, if the Fed Chair Powell comes out and says, yeah, we're going to hike the 25 basis points, but we're feeling pretty good. Inflation's been moving lower. We feel like we've got it under control. That could be a reason for the stock market to move higher. As you see here, the relationship between rates and the stock market, a little bit more nuanced, but can be very important to the stock market, because you could almost say that interest rates can get in the way of earnings that then feed into that stock market. So it's all part of the same synergetic organism here. Our economy is, so to speak. So where do we go from here? Well, the NASDAQ is within a stone's throw or two from all-time highs, topped out in the later part of 2021, early part of 2022, around 16 and change. I believe it was like 16.4, 16.5. Last week got above 16K for a brief moment there. And we've come off of that in the mid 15,000s. But if you see a really good earnings cycle here out of Microsoft, Google, Meta, and then I believe Apple is next week, and we'll have NVIDIA in the coming weeks. And you see lower interest rate expectations or just less fear around inflation, that could send stocks higher. That would be, the historical relationship, right? Good earnings, good stock price action, or bullish stock price action, and the stock market maybe heading back towards those all-time highs. On the flip side, if you see the continuation of this Netflix, Tesla bearish type of earnings reports, and if you see the interest rate expectations higher, we're afraid of inflation or we're afraid of this or that, then that could send the stock market lower. And of course, don't rule out these two pieces canceling each other out, good earnings, higher interest rates, lower interest rates, bad earnings, that could also kind of create a mixed effect. So of course, a lot of nuance, a lot going on in terms of earnings and interest rates effect on the stock market. But we will see plenty of data coming up here in terms of the earnings schedule and the FOMC schedule to add to our brains and our trading portfolios moving forward. So it's going to be an exciting one here to see how earnings come out, interest rates come out, and how the stock market digests it.